Hey guys, welcome to today's session. I'm going to give everybody a moment to join and then we're going to get started. I would appreciate it if somebody in the Discord could confirm whether they can see my screen and hear me loud and clear. That would be absolutely fantastic. If you're watching this stream on Instagram, it does give me a warning saying that there's some issues with Instagram streaming at the moment. So if it cuts out, I apologize for that. However, we are live on X, YouTube, and Discord as well. So you should be able to switch streams over. Okay, perfect. Thank you, Jimmy, Crosby, and Julian. Thank you all for confirming everything sounds okay. Now, if you haven't been to one of these sessions before, it's my favorite session that I run every single week, and it's where we really deep dive into a trader strategy and we take a look at different statistics and variables that potentially the trader might not be looking at on a weekly basis. Now, as a little bit of context, I've been a trader for the past 6 years. And before I become a trader, I was a data analyst. So this is kind of combining two of my, I don't want to say passions. Trading is definitely more of a passion than data analysis was. But I look for patterns, like repeatable patterns within data sets and within key variables that might not appear kind of to the naked eye. What I mean by that is that most traders will search for an edge on a chart, right? And rightly so. A chart is kind of the first level or first layer of data that we get from the market. Having said that, most traders think that the answers remain on the chart to improvement, that is. Now, I disagree, and I think there's a lot of variables that you should take in. There's an unlimited amount of sources of information that you can get as a trader. You have macro events, you have times of day, you have the day of the week, the asset that you're trading, or there's just an infinite amount of variables that could affect the P&L of your position or the success of you as a trader. Now, when you start building a record or building a history of trades, you begin to build up a data set. And this data set is great because it doesn't just show you about your edge. It doesn't just show you whether your edge works or not, but it shows you whether you work as a trader. Just taking off my jumper because it's roasting hot. Now, what I mean by that is you might have an edge that is fantastic and that works long term. However, if you keep getting in your own way, the only way that you're going to know that is by looking at how you perform with the edge, right? Otherwise, I actually had an interesting conversation with one of my friends the other day. We were on a call and we were just talking about something random, and he said to me something that I've noticed is that on I think it was gold or S&P we looked at. I think it was the S&P, and then I tested it on gold afterwards. He said when the Friday close is bearish, there's a super high chance of Monday closing bullish. And so I said, okay, well, let's build that and we'll see. So I threw a quick system together, written in MQL5 code, threw a quick system together, and rightly so, lo and behold, he was correct that it had a positive expectancy over a period of time on the S&P and on crude oil, that this strategy worked over time. Okay. Now, the issue with that is we see the data of that specific strategy. We understand that strategy is going to pay off. However, not every trader is built to take one trade per week. Not every trader is built to go through X amount of drawdown or X amount of consecutive losses. Like, there's so many different variables that come into it outside of that system. You might get in, might go slightly into drawdown, and you close it early because you think it's going to be a loser. But then it turns into a winning trade, okay? But you only know this sort of information if you study your own behavior. Now, bringing it back to Darwinex, before I go off on too much of a tangent, which I tend to do in these sessions, so don't hate me for it. This is the kind of ultimate look into your performance and into how you trade. We track just an insane amount of different variables that we're going to go over today on both Darwinex Zero and Darwinex. So we'll take a look at both platforms. I will do a live example. So if there's anybody in the session right now who wants their Darwin analyzed, and by that I don't mean I'm just going to say whether it's good or bad, because I won't do that. I mean, we'll take a look at your metrics. I'll provide real-time examples of things that you could potentially take a look at to improve your system or to increase the efficacy of certain things that you do. Oh, sorry, I was struggling then. So if somebody's in the session and wants their Darwin to be looked at, please. Okay. I see Chimmy has just put his Darwin in, so we'll take a look at that. EGXL. EGXL. Darwinex. Take a look. It's important for me to caveat at this point that okay, this is enough. So it's important for me to caveat this at this point is that you have to have a certain amount of data to be able to analyze. It doesn't work analyzing a month's worth of performance or 2 months, 3 months even. I usually say a minimum of 6 months is enough to understand how you are operating in general. And what I mean by that is generally over a 6 month period, you start to build up habits, you start to build up patterns, and that then becomes noticeable in the data without having too many anomalies. If you're doing a month, there might be loads of anomalies and you don't know whether that's a pattern or whether it's simply an anomaly. Now, the caveat to that is that you get frequent traders, non-frequent traders, scalpers versus swingers. So while somebody might have 2 years worth of data, they might have only taken 10 trades. You might have somebody who's only got 2 months worth of data, but they've taken 1,000 trades. So you also have to account for that. However, we're trying to assess long-term performance and whether a strategy will work over different market conditions. So of course you need in-sample data and out-of-sample data. What I mean by that is not just a condensed period of time where interest rates might be positive or interest rates might be negative. There might be growth in the economy. The economy might be contracting. And a strategy might perform really well during one of those market cycles, but then fall apart for the rest of them. So we have to understand. And that's why I like the longer records, because you can kind of take more away from it. However, I think this EGXL is 6 months. 1, 2, 3, 4, 5, 6. So we're going into our 7th month. So hopefully we'll be able to get some good insights from your Darwin. Jimmy, I appreciate you putting it forward for me to review. So again, before I start rambling on about random things, let's jump straight into it. So we've had an 8.53% return with a max drawdown of 6.29%. So what it looked like is you had a decent period to begin the year, and then as many traders did, you had since the end of February, you struggled through March and April and then sort of pulled it back in May. Now, actually, that period wasn't as bad as most traders. What I've noticed from studying a lot of Darwins this year is generally January is green, Feb, March, April, May have all been red. I've followed that pattern myself. I struggled from February to May and have only started clawing back in June. But I wouldn't feel too bad about that period of drawdown because the markets have been really, really tough. And I think even at this point, the markets are still being pretty tough. But you've been flat since mid-May. Let's see how many trades we've got to play with. Okay, so 768 trades, which gives you a daily trade frequency of 6.19. So I'm going to go out on a limb and say that this is an expert advisor, or you're just a really active trader. So you might be a scalper, or you might be pyramiding into positions and kind of pyramiding into trades to build a position as opposed to executing once. Let's take a look at what you trade. So these are, if you've been to my sessions before or you come to them often, you'll know I bang on about the same things quite a lot. And the reason I do that is because there's certain things that I think are really beneficial that a lot of traders overlook. And these three, well, maybe not the trading time distribution, but we'll cover that in a moment. The asset allocation and the return distribution by the day of the week are two really, really important metrics, I believe, that can change a lot of traders who might not be struggling, but they might be two metrics that can boost any trader without having to specifically change your approach or change your strategy. Jimmy says that they're an active trader, no bots for the moment. Okay, So yeah, 6+ trades per day is a lot. So I would imagine you have quite a lot of desk time and you're not holding your trades for too long, but we'll see your average holding time shortly. So you've got 54% of your trades coming on indices, 22.79% on Forex, 20% on commodities, and then just 2.73% on stock and ETFs. 68% win rate on indices with a return of 5. 69% win rate on FX with a return of 0.5, and then a 69% win rate with a return of 3 on commodities. So interestingly, I think your win rate is pretty much standard across all assets. Let's take a look at your combined win rate. Okay, so 68.62% win rate with a payoff ratio of 0.63. Again, I'm going to go out on a limb here, but I'm not sure whether it is, but do you martingale or do you grid into a position? And by that, I don't mean that you trade a martingale strategy, but do you enter an area multiple times if it goes into drawdown? The only reason I ask that is because sometimes that gives a higher win rate with a lower payoff ratio. Again, just a pattern I've noticed. But of course, it's not the same for everybody. Sometimes, yes, try not to. Okay, that's fine. That's fine. It doesn't seem to be affecting you too much now at the moment, the way you do it anyway. Interestingly, I try and look for discrepancies here. I try and look for things that kind of initially stand out. And the main thing that stands out to me is that your win rate is pretty much identical on indices and FX, okay, albeit you've taken twice the amount of trades in indices. Your return on indices is almost 5.5%. However, on FX, it's 0.5%. Now, even if we said you took twice the amount of trades on FX at this same pattern or same rate of growth, so you had just over a 1% return, that's still a 5x difference in terms of expected value from trading FX to trading indices. Okay, got the same win rate. We would equalize the trades, bring up your return by double pretty much, but you'd still only have a 1% return compared to a 5% return. Now, sometimes it can just be a strategy works better on specific assets. Sometimes it can be that you got lucky on one trade and it throws this data out. But this is something that I'd be looking at over the next couple of months to see if this continues in the way that it does. What's great now is that there's nothing to worry about. There's no damage control needed. You're not negative on FX. You still have a positive expected value because you are positive since inception. However, if we double this, right, and we go 12 months down the line, I've made 1% on FX, 6 months down the line when we have a year-long track record. We'll just double your trades just for argument's sake, just to make sure that we're, staying in line with your previous data and that you don't change anything moving forward. So you got 800 plus trades on indices and however many it was on FX. Same win rate, let's keep that standard. However, your return now on indices is like, 11% almost, but your return on FX is 1%. Now, that's a massive difference, and I'd be asking myself, why is that happening? Not only would I be asking myself why that was happening, I would probably just look at dropping trading FX and focusing on the asset that I'm better at. Flies in the face of what a lot of traders would believe is the better decision to make. Generally, people think if they've got an edge that works on all different assets or in every different variable, then they should trade it. But actually, I come from the standpoint where I think trading is incredibly difficult. It takes up a lot of mental capacity. You have to make a lot of decisions and you have to spend a lot of time perfecting what you do. Now, I can trade indices 10 times better than I trade FX. I'm going to give that 110% of my attention. So whilst I might be dropping 1% return per year because I'm dropping FX and I'm not worrying about it, it's going to bring your value at risk down, which will likely increase your risk multiplier because you're trading less. So your trade durations less, your trade frequencies less, you've got less exposure when it comes to position sizing, you're trading less assets, and therefore your VAR should drop down gradually. Not a massive jump, but it should drop down, which therefore would mean your risk multiplier would slightly increase. So not only are you focusing only on indices where your edge is higher, but your actual return from these moving forward would probably also be higher as well, because generally as a trader your exposure is lower, and so you're being scaled up a little bit more. So that's one benefit. The second benefit is the time that you spend on FX trying to A, build it, or B, trade it, or C, review it. Spend all that time perfecting the one thing that you're good at, which at the moment looks to be indices. Now, you do also have commodities. So commodities, 155 trades, roughly there or thereabouts, the same with FX, same win rate, pretty much to the dot. But again, the return sticks out. You get 3.24% return, again, compared to 0.58% from FX. So it's clear that per trade, your payoff on commodities is higher than the rest. I just don't trust this data just because you've got 155 trades compared to 417. Now, again, I would probably monitor this for the next couple of months. I wouldn't make any decisions as of right now, but I would monitor this pattern and the rate of growth of return over the next, I don't know, 3 to 6 months. And if it continues, I would potentially be sitting down and trying to make a decision. If I was you, this is to go, do I completely get rid of trading FX, focus on commodities and indices, and really try and nail what I'm doing there? Because to me, that would make sense. You're sparing yourself the mental clarity. You're not losing too much from a return perspective, and actually probably may even scale up your other trades because you're taking less exposure to generate the return. And you're going to live an easier life. Less work, more reward. I'm always a proponent for that. Split it by asset. So you trade, you trade a hell of a lot, man. NASDAQ, S&P, the Nikkei, UK 100. You trade pretty much every European, US, and UK indices. What was that one? Okay, so again, I'm going to take this further, and we split it by asset. I don't think you need to trade the Spanish, the French, the Euro stocks. 95% win rate on Euro stocks almost, and you've made a fractional return. Potentially save your exposure on those three assets. Keep the DAX 100%. DAX looks to be probably your highest returning asset. UK 100, the Nikkei, the SPU. Just get. This is my opinion, of course, and you don't have to take my advice on this. So don't think you do. But I would be going, well, what I'm doing is working on 6 or 5 of the assets that I'm trading. So do I focus on them, or do I keep trading the UK 100? Do I keep trading the French index? It just doesn't make sense, right? We have positive return on the NASDAQ, positive return on, where is it? The DAX. And then, what was the other one? I think it's just that. Yeah, so maybe even dropping it just down to the DAX and the NASDAQ. Again, this is all hypothetical because we can't go back and change past behavior. I'm just going on the data that we have. If you'd have just traded the DAX and the NQ, you would have a higher approximate return than you do now. Again, less work, more reward. Focus on what's working, strip back what's not working. I'm not going to go too granular with the comparison of asset to asset because, of course, it looks to be that you have a much, much, much higher expected value on the DAX than you do on the NQ. However, again, the reliability of the data just probably isn't there. We have 228 trades on the NASDAQ, whereas we only have 21 on the DAX. So the integrity of the data can be questioned. However, again, it's all about the pattern recognition, seeing if it continues. If it continues this way, where when we hit 42 trades and you've got a 10% return, then of course you know that it's less likely to be an anomaly, right? And that pattern's likely to continue. Going to skip FX because I don't think we need to really talk about that. I mean, do you make the decision now? Potentially not, but I would be looking to get rid of FX from my portfolio, unless you can prove to yourself over the next 3 months that this was just a period of time of underperformance and you can come out the other end and perform well with FX. Again, gold, fantastic, 75% win rate. Again, sample size is slightly higher than the DAX with a positive return of 3%. I think it's going to be the same story pretty much. Yeah, like potentially just focusing on precious metals, maybe. I don't know, maybe crude too. Okay, so Chimmy says just trading FX because positive swaps are any news. Okay, so there's a caveat to why you're trading it. You're not trading it at the same rate as the others. I would just ask yourself long term if that benefits you. Like if that benefits you as a trader more than the downsides do, then continue doing it. If it doesn't, I would again sit down and have that conversation with yourself. And again, nothing that I say is final. These are just ideas of things that you can look at mending or look at changing over a period of time to try and get to that next level. Okay. So moving on to trading time distribution. First thing to note that this number of trades is inaccurate. This shows trading decisions. So there's basically double the amount of your total trades here because it shows your activity instead of your trades. So it shows the opening and closing of a trade. Now, again, obvious standout is European session. That's where you make the majority of your trading decisions, and that's the only session where you have a negative return. I'm presuming that you're not European based, or maybe no, sorry. Yeah, you probably are because that's when you're most frequent. I don't know why you have some activity through the night. I'm presuming that's just having limit orders hit or stops and targets hit, but it's still pretty active. Again, I'm not going to get too granular comparing Asian session to US session because I think we can clearly see that if we times this by 5, your Asian session would be the most profitable. But again, lack of data gives lack of integrity. But at the moment, the US session looks to be where you make the majority of your return. What's difficult with this and why I don't think it's the best metric to get to lose too much sleep over is because you might be entering the trade during the European session, as in you might enter all of your trades during the European session. And then, the ones that you get stopped out on are also in the European session because you might have an average stop at 30 minutes, but your winners might all have an average holding time of 5 hours, which would push them into the US session. Okay. So even though you've got less trades because it's just exiting positions, you've made a higher return. Same with the Asian session. Maybe these are all targets. Maybe these are all trades, right? Or executions. You just don't know. So I don't think this is the best metric to take a look at. If there's a huge standout, I tend to say, well, just avoid that time. Like if you're a scalper, for example, and your average hold time is 5 minutes, then this might be a little bit more relevant for you because you know that you're not going to be holding trades from session to session. But in your case, I wouldn't lose too much sleep over this data point, to be honest. Return distribution by day of the week. Now, people will know this is my favorite metric. I love looking at this because it tells such a story about the trader. There is sometimes a technical influence on this statistic sometimes. So I always say if you're trading a mean reversion system, there are going to be days of the week where you have a better return or where you have a higher expected value than others. I know specific assets have days of the weeks where they're most likely to form the higher or lower of the week. I know this because I've done the research and I've gone and collected the data. So I know if I'm trading a mean reversion strategy, those days are the better days to implement that system. However, if I'm trading a trend following strategy, I don't want to be trading it on the same days where the market is likely to mean revert. Okay, so there can be a technical caveat to this. There can be a technical reason why you overperform on some days and underperform on other days. However, a lot of the time, this is due to trader behavior or what would you call it? Commitments, routine, personal life. You might have something that you do every Wednesday. You might work 2 days a week and notice that the days that you work, Tuesdays and Thursdays, your performance is lower. Okay, well, we can directly correlate that with your sat at your desk, you're trading from your phone instead of your PC, and therefore over time your performance is lower. Now, what you can do in that scenario and in any scenario is you can either stop trading during that period of time until your situation changes, or you can implement a risk barometer, and you can scale your risk dependent on your expected value. So if you have, based on a few different variables, maybe it's the asset that you trade, maybe it's the day of the week that we're on. We'll combine those two for now. Let's say your highest returning day is a Friday. Okay, so we know generally you produce the majority of your return on a Friday. Now, let's also combine that with the DAX, your highest returning asset. Now, if you have a DAX trade on a Friday, your expected value is far, far higher than what's your worst day. So a Monday where you're negative over the past 6 months with, let's find a bad asset. Let's just use an FX pair. Or whatever. We'll use XNG. Let's say you have a setup on that asset on a Monday. You're from two different variables, your expected value is lower. Therefore, on that singular trade has a much lower expected value than your DAX trade on a Friday, for example. Regardless of what the chart is saying, regardless of the latest candlestick that's formed, regardless of the indicators that you watch or the price action patterns, you're based on your history as a trader, which is including your behavior, your mental stability as a trader, your decision-making ability, your chart, the day of the week, all these different variables, we know your expected value is higher, and therefore we can push the risk slightly. And when I say push the risk, I don't mean double or triple the risk. I mean maybe push an extra half a contract or just half a lot or an extra contract on there. Increase your exposure slightly because you know that the cards are in your favor. I always relate this back to professional poker players. I'm not a big poker player myself. However, I know how the game works. I know how the mental game of poker works. But anybody who knows what poker is will agree with the fact that a poker player will never bet the same amount on a poor hand that they will on the best hand that they can have. Of course, they're going to increase their risk slightly when they know that the odds are in their favor. They might not do it recklessly, but if I've got a royal flush, I'm putting more chips down on the table than if I've got a 2 and a 6. Okay, it just makes sense when you have a higher chance of winning. And I'm not just talking about win rate on a trade. I'm talking about your expected value. When your expected value is higher, it makes sense to push harder with the risk. And same when you know your expected value is lower, it makes sense to scale the risk back. Not enough so that you're basically not trading it, so you're not putting a fraction of the risk on, but maybe slightly lowering it. So if you have a barometer of 1, which could be 1%, but it's just 1 on the scale, we might push our highest expected value to 1.2 and our lowest expected value trades to 0.8. Again, could be related to 0.8%, 1.2%, but if you risked 5%, you might be looking at 7.5 and 2, for example. But it's a concept that I really think a lot of traders should onboard is grading their trades, but doing it with a risk barometer, understanding your expected value, and then pushing your foot on the gas. There's not too much to take from your return distribution by day of the week, other than Fridays and Wednesdays are clearly your top performers. It's too early to tell. You've only got 6 months, and 6 months times it by 4. I mean, you can see the numbers here. You got 22, 23, 20, 20, 19. So you haven't even got 25 of any individual day to judge this off. So again, are these anomalies? Who knows? But over a year, you're going to have, 56, 52, however many weeks are in a year. It starts to, every week that goes by, every time you take a trade on a Friday, you're building data, you're building your edge. This is the best thing, or this is the best thing to think about when you're having a crappy day and you might hit stop loss, you might take a really bad trade or make a bad decision. Just think about it that you're building your future edge. So you're building your data to understand how to improve in the future. You can't take back what you've done. The market is brutal. It's not one of those things where you can click restart. You have to own every decision that you make. But view the poor decisions that you do make and the lessons that you learn as future-proofing yourself, okay? It might not mean much to me now, but in the future, I'm going to use this data. You know, that stop loss, I've just lost X amount of money. It feels really bad. Okay, well, let's put that aside because one day this data, that decision is really going to help me improve. I don't know how, I don't know when, but it's going to become a certain part of a variable that will help me understand my ability as a trader in the future. It's the best way to think about any tough period or any tough trade. Okay, so strategy statistics, 768 trades, 6.19 per day with a win rate of 68.62, payoff ratio of 0.63. So it is a negative payoff ratio, which means you have to maintain that high win rate. I don't think it doesn't look like you have an issue upholding that high win rate. But you kind of are reliant on being correct a lot of the time. I think potentially you're at the stage now where you should try and look at how to push that payoff ratio, which we'll get onto in a moment when we start looking at excursions. The win rate, what you should be doing now is running simulation tests on all of your trades to try and not reduce the win rate as much as you can whilst increasing the payoff ratio. The best way to do it is measuring your maximum favorable excursions, running sim tests or a Monte Carlo test based on different excursions. So if you're taking 20 pips a trade, for example, what would happen if you took 22, 25, 30, and seeing over a long period of time how it affects not only your payoff ratio but your win rate. You know, if you run a sim test and it shows that your payoff ratio has gone to 3, well, it's fantastic at face value, but then if we look at your win rate and your win rate's dropped to 10%, yet, you know, great, you're taking 3R or 3% from all of your winners, but you're only winning 10% of the time. So what I would say is trying to keep your win rate above 60, 65% whilst trying to push your payoff ratio moving forward as high as you possibly can. So it's kind of like usually you have to sacrifice one for the other. But is there wiggle room for a bit more without sacrificing the other too much? Profit factor of 1.38. It'd be nice to see that above 1.5. Potentially it will, you know, after a year. Average winning trade 0.06. Average losing trade 0.1 or negative 0.1. Average losing trade duration is 1 day, 4 hours and 5 minutes, and average winning trade is 1 day, 6 hours and 31 minutes, which means you hold your winners for an additional 2 hours, giving you a positive duration ratio of 1.09. Now, what this tells me, and I could be wrong, is that you don't cut your losing trades quick enough. I generally think, unless you're a swing trader, a day is a good enough amount of time to decide whether you're right or wrong on a position. And now I don't know how you trade, so again, you know, tell me to shut up if I'm completely off the mark here, but I would presume that there will be early warning signs in a lot of your trades, and yes, it might affect some winners too, but there would be early warning signs that would give you the ability to potentially look at cutting your losers quicker. Okay? Yes, it might mean that you cut some winners quicker as well. But if we can cut down a lot of losers, your return might still be higher. Now, again, that's going to take a lot of manual work to look through all of your trades, especially you who has so many trades, and just taking a look and going, okay, is there a repetitive warning sign that I get? Not on every trade, but on a lot of trades. Something that is a recurring theme. Maybe it's, I don't know, a swing failure in the London session happens 5 out of every 10 losing trades. Okay, we're never going to get rid of all losing trades, but if we can cut 10%, 20%, 30% of them, then that's fantastic. Your average losing trade duration might come down and your average winning trade duration might go up because you're able to hold trades longer because it's not flagging the early warning signs. So a very basic thing that I do with this is looking for acceptance above or below a level. If I give myself a wide enough stop so that I can let the market do its thing, because who am I to say the market has to turn at a level? But what I'm looking for is if I'm interested in an area and I'm in the trade, I have my eyes on that area. Does it close above? Does it close below? Do we get acceptance? Or does it look like a bit of a stitch up? If we get an acceptance and it looks like I'm going to be wrong, I'm very happy to cut that trade. If it then reverses and goes in my favor, cool, I can get back into it. I mean, I don't usually, but the option's there. But quite often what I've found, and this works really well for discretionary traders who have a lot of years experience, is that you can kind of rely on your gut instinct as its own variable. Okay, it's not always the most accurate, and I don't advocate new traders doing it, but quite often I'll look at a position and price is turning and it's, might be coming back against me. And instead of going, oh, well, I'm going to scale my stop to break even so that I don't have risk on the trade, which is just a stupid statement, and I'm not even going to get into that. I go, well, if I was to move my stop to break even, that basically means I'm happy to take a break even on the trade. I'm just going to close it. Okay. As soon as you start getting that decision making, what is the best decision to make in this moment in time? And you have to kind of become brutal with cutting your trades. Okay. I think that's something that you could potentially take a look at, is trying to cut your losing trades quicker than you do right now. Again, trying to find patterns that you see a lot in your losers. Might cut some winners out, but as long as you're cutting more losers, then it's worth it. Nothing much to talk about here on the duration versus profit. This basically measures how many pips you win or lose based on how long you're in the market. Because you've got a high win rate, you can see it's more populated on the right-hand side, of course. What's weird is that you've only lost 11 trades being in the market for an hour to 2 hour. So I always mark my expected value based on how long I'm in the market. So each row here has its own expected value, okay? The best way I do this, or the easiest way I do this, is I just count the amount of trades that you got on the one side versus the other side. So you can see on the top, after you've been in the market for 5 days and 8 hours, you've won 3 trades, you've lost none. Technically, you've got 100% expected value at that point, but there's only 3 trades. So really, again, there's just a lack of integrity when it comes to data. So I wouldn't put too much emphasis on that. However, what you can say is, after 5 days and 8 hours, if you're still in the trade, you know you're onto a winning trade, or that there's a significantly higher chance that you're onto a winning trade, because generally, when you get there, you don't lose the trade. Okay? Scalpers generally have a hot zone down in their first 30 minutes, which is where they win the majority of their trades, obviously. Works opposite for swing traders. That's generally their hot zone, their danger zone, where that might be where they take the majority of their losers. They get into the market, it just carries on moving against them, and they get stopped out pretty quick. But the longer that they're in the market, the higher their expected value goes, because they're allowing their trades to breathe, but they're not allowing their losers to just keep going against them. So again, it's about going, okay, well, I usually win more than I lose within the first 30 minutes. So actually, once I've executed, I can kind of take a breather for 30 minutes, because usually I don't get stopped out at this point. After that, that's where my edge starts to deteriorate. Okay, being in the market for 6 hours, I don't usually do too well up here. So I need to think about cutting my trades at this point, winners or losers, because usually from this point onwards, 90% of my trades end up being a loser. Again, it's a very niche metric to take a look at, because it doesn't affect everybody. Like it's not something that everybody can take value from. But I have seen a few cases of this where I've just said, listen, when you're in the market for the first 30 minutes or the first hour, keep an eye on what you're doing, because you need to make quick decisions within that period of time. After that, let your trades run. And they go, oh, I never thought about that, but it makes sense based on their what they know about their strategy or their system. Maximum excursions. This is okay, to be honest. I mean, I don't like this one bar that was super big down here, this NASDAQ trade. I mean, it looks like it was a pretty big loss. Kind of counteracted by this DAX trade over here, which makes sense why you have such a high return on the DAX. Generally, what I like to see here, and it's not always easy to do, but what I like to see here, let me just load my pen, is a more consistent kind of range, right? Where the range might be more like that. Okay, now you only really have one outlier, which is this. I would say maybe if you cut your range smaller, you would have more outliers. Okay, so when trades start to move against you, what this will help you do is identifying the optimal region. Again, you might need to run some sim tests. Your target region might be slightly lower as well, something like that. Okay, running some sim tests and going, okay, well, if I enforced a hard stop here and a hard target there, how would my strategy look? It might blow up your system completely. Okay, and like I say, the suggestions I make aren't for everybody. For all we know, this trade, and this trade is the reason that you're above water. And it probably is, because that DAX trade is just under 7% and your return is what, 8 point something. So probably the reason that, you know, you're above water. However, if you ran a sim and said I'm enforcing a hard stop at this much drawdown, what would that do for your strategy? Yes, you'd probably take 1, 2, 3, 4, 5, 6, 7, 8, 9 more losers, but cutting those losers shorter, would it make you more profitable? For example, you would save all of this drawdown. So that's 4% candle, that is. So that's probably 3% drawdown, probably another 0.5%. Okay, probably another 1%, probably another 1%. So you know, you might be saving 5% worth of drawdown, would affect your win rate. However, you're saving a lot of drawdown, or a lot of negative, what should we call it? I don't know, just a lot of downside. Your mic is only right channel. Okay for now. Not sure what you mean, Johnster. I'm hoping that you can hear me and see my screen still. Let me know if you can't. But yeah, so that's what I tend to look for here. I like a really tight range. I think it's nice when it is. Let me clear this up for you. This is an example of one that is really nice. Something like that. Okay. So again, taking a look at this, what's the average? So the average is 0.41, which is somewhere around here. Average positive is 0.59, which is probably somewhere around there. Their best is 1.29, which is this one here. Worst, 0.92. Okay, so what would happen? And again, this is all hypothetical. What would happen if we started enforcing a hard stop at that median, or just past the median excursion? So let's say your average is 0.41. What would happen if we put a stop on every trade, 0.45%? I butchered that. Again, it would probably bring your win rate down slightly. However, would the increased position size that you get from all of this, you save all of this exposure. So what I mean by that is, because your stops would be smaller, you can potentially risk more. So you can put more, or not risk more, you'd be risking the same, but you'd be putting more lots or more contracts down on the individual trades. Would that counteract the higher or the lower win rate? Okay. Now you can see for this trader, specifically, the majority of these trades are all stop losses. In fact, they all are, I think. This trader has a set and forget. So they place a trade, it goes to target or stop. Now, we can categorically say, if they enforced, or hypothetically, if they'd have enforced a hard stop at 0.45%, they'd have saved money on every single one of these positions. So they'd be way up. Okay. Of course, that's all hypothetical and we can't change what's in the past. But it's about going, okay, where does the market usually push to on my winning trades? Okay, where does the market usually push to? Finding the difference between that and your losing trades. Okay, so Jimmy said, I'm not a fan of stop loss. Lots of time lost money and then changes tendency. Yeah, all I would say is you have to be very active. You have to be active enough to know when the market is still going against you so that you can cut those trades. And you have to be absolutely brutal at making decisions. You have to be able to cut trades. Like, a stop loss is kind of your way of just going, okay, that's it, I'm out. Like, don't need to do this. Like, don't need to be in this trade anymore. If you don't have that, you have to be ruthless in being able to make a decision on the spot. Something like this, if you run a sim test and it works better than what you're doing now, I would always say just be open-minded. This is just about refining your stops and your targets. But yeah, let me clear this off again. There we go. Back to EGXL. Value at risk, 33.01%. So I'm presuming that your signal account is probably about 30%, maybe 30% return. Again, if you're not using stops and you're pyramiding into trades, then 33% kind of makes sense. What I love about this is how stable it is. Okay, so you're doing roughly the same thing day in, day out, week in, week out, month in, month out. You don't have too much spike or divergence in your VAR. I would say just be careful. It is slightly higher than what I would say it should be. Technically, anything above 30%, what we've seen over the past 13 years of Darwinex being around, is above 30%. Traders have a really, really high chance, or not that they have a really high chance, but the chance of that trader blowing up increases exponentially as they go above 30% value at risk. Trying to take it down, this is why it's very plain. Okay, so just do it gradually over time. I mean, there's a few different ways that you can do it. Some strategy related, some position size related. Well, one position size related. You can stop trading high volatility assets, but you would have to change the way you trade to do that. You can lower your trade frequency. So instead of peppering so many orders, you can kind of aggregate an area and just trade that. Again, you would have to change a certain element of your system. You could change your trade duration, so you can reduce your average holding time. Again, some of the things that we've talked about today is reducing your average losing trade duration. So even working on that should bring your value at risk down. And then last but not least, sorry if you can see my dog, is reducing your position sizing. Okay, so obviously reducing your position sizing means you're taking less exposure, means you have a lower value at risk, means you have a higher risk multiplier. You're kind of on the border, right? I'm not concerned. 33%, yes, you're above the threshold, but fractionally. I would say try and bring it down slowly. Just slowly reduce your position size. 2 seconds. Hey, come here. Sorry about that, guys. Somebody's outside the house, so dog's on guard mode. Yeah, you're only fractionally above the value at risk that we kind of advise, so I'm not too concerned. I would just say try and lower it over time, but just gradually reducing your trading size should sort that out without having to fiddle about with your system too much. Now, let's take a look on Darwinex.com. So if you aren't aware, you can view your statistics on Darwinex.com, even for a zero Darwin. So you have to log in. If you don't have a login to Darwinex, then you can use your Darwinex Zero login and you should be able to log in fine. Then you go to Darwinex.com/Darwin/ your 4-ticker Darwin and then a hashtag. Don't ask why the hashtag works. I just know it does. And then you should be displayed with the screen like this. Now, the reason I take a look at this is because we have a few more metrics on here that we don't show on Darwinex Zero. However, a lot of them are the same. So we have these little investable attributes up at the top here, and we basically score you on separate measurements or metrics, let's say. So the first one is experience. You've got a 4.2 out of 10, but this is one where I always say don't be disheartened if it's low, because that's basically just us saying we don't have enough confidence to say that this trader's 6-month record in your case is representative of a 10-year period, because we just don't know. The only way to increase this is just by keep trading. More time, more trades will increase your experience score. That's literally it. There's nothing magical about it. There's nothing that you need to do. It doesn't put investors off if the experience score is lower. It just means that, you know, the record that you built thus far, we can't really say that it's representative of a longer period of time. Or we just have a lower confidence level, basically. We then have market correlation. So you have a high score of 9.4, which is generally the case for most traders, unless they're long-only traders. And this basically measures your ability to trade both sides of the market. So do you trade long as well as you trade short, and vice versa? Like I say, the only traders really that struggle here are long-only investors. They're the only ones. And the reason for that is you know, of course, it's easy to make money in a bull run, but it's hard to make money long only in a bear market. So of course, those traders or investors, let's call them, are going to struggle, or maybe not struggle, but they just won't perform as well as they do in a bull run. Risk stability is your value at risk. Risk adjustment shows how often the risk engine gets involved in your trades. So there's red dots for when the risk engine closes a lot of your position. There's orange dots for when the risk engine closes some of your position, and green dots for when it closes none. You can see you've got a couple of orange dots up here where the risk engine got involved and closed 0.3, 22.61, 22.48, and there's a couple more over here. Now, what that means is if your deleverage exceeds the threshold of your average trading deleverage, the risk engine can step in and close some of the position so that your exposure isn't kind of getting out of control for your normal habits. It doesn't really affect a trader's strategy too much, and quite often it can turn a losing trader into a winning trader. We have an example. So BLM is a really interesting Darwin. So if we look at their risk adjustment, in fact, no, we're looking at the wrong thing. If we take a look at their underlying strategy, yeah, sit down. Take a look at their underlying strategy for BLM over the whole period. Now, this is since, oh, it doesn't say the date on there. This is since January 2018. Okay, so we've got a 7-year track record here. Okay, no longer active, but 7-year track record. Or let's say 6-year track record because they stopped a year ago this month actually. Underlying strategy is over that whole period of time, over 6 years, is down 4%. So they basically made no money over a 6-year period. They've had peaks, they've had troughs. So that peak was like what, 150% return pretty much. Then they went down 60% into drawdown, rode 70% into drawdown, again built it back up. But they basically made no money because after 6 years, they're down 4%. Their Darwin, however, is up 78.42%, averaging what, 10% per year, 11% per year. The only thing that's different is the risk engine. The risk engine is adjusting the position size so that it's more stable. The risk engine might also get involved in their positions and close certain amount of exposures. So it's not a bad thing, even when it does get involved in your trades. However, you've got a 10 out of 10 score, basically meaning that the risk engine doesn't really have to worry about getting involved in your trades too much. The next ones are quite complex for me to explain. I always struggle. It's the open and close strategy. They are displayed on the same screen. So no matter which one you click, you can see you've got open strategy at the top and close strategy on the bottom. This is a custom metric that Javi Colon built for Darwinex. And it basically measures within a time region the efficacy of your trades, depending on whether you entered or closed them 10 to 50% before or after where you do. Now, what I am going to say is that if you want to know more about this, come to help.darwinex.com/open and dash. Do you know what? I'm just going to put it in the Discord. Go to this page and read about this because it is quite complex. And basically what it will do is it measures how well you rank compared to if let's say your average trade duration is 10 hours, 10% would be an hour, 5% would be 5 hours. Simple maths. It gets a little bit trickier when that's not the average trade duration. However, this is saying for you, for example, 30, 40, 10, 20, 50%, getting in the market after you would benefit from on all accounts, whereas you actually perform better than if you got into the market earlier than you did. Okay. Exactly the same with closing. So holding on to your winners for longer, you would outperform what you're doing now. If you was to cut trades sooner, you would underperform what you're doing now. So this is a really nice metric to tie in with the excursions to be able to run your winning trades for longer. I mean, it's clear for you, just holding your winning trades for longer, you're generally going to see a benefit, right? I feel like I've got a sneeze coming on. So if I start having a sneezing fit, I do apologize. It's a problem with UK summer. We have really bad hay fever over here, or really high pollen count. The next three metrics we've already covered, which is your duration and return consistency. We covered that on D0 with the duration versus profit. Covered your loss aversion, which is your maximum excursion chart. Now, one of our really nice metrics on here is the performance chart, which is a Monte Carlo test comparing your Darwin to 10,000 random strategies, all operating at the same risk level. You can see currently you stand at 82.87%, basically meaning that you're outperforming 8,286 random strategies, okay, out of the 10,000 uncorrelated strategies, all running at the same risk level, okay? The reason I like this so much is because if you start to make a change, let's say you start dropping an asset or whatever it may be, any of the things that we've discussed in this session, if you start making a change, you can judge. I'm just going to close this window because there's some work going on outside and it's really, really loud. You can start judging how well received the changes have been. If you drop an asset and then, or a day of the week, for example, and you start to see your performance chart going up, it generally means that, you know, what you did was the right thing to do. If you make a change, like let's say you start implementing a fixed target or fixed stop, and then all of a sudden you see your performance chart dropping over the coming weeks or months, then you know it probably was a change that would need to be reverted. It probably didn't pay off. And over time, you'll see that your edge is less effective. It's giving you real-time feedback into some of the changes that you make. And it's kind of always nice to know where you stand in terms of, not against other traders, but in terms of against... Sorry, guys. Up there now. On your bed. This is the problem from working from home, is that you have family jumping on your streams, you have a dog barking, you have people working outside. It's just, yeah, it's mayhem here. However, back to the performance chart. It's just really nice to know how you stack up against such a vast amount of strategies that are all basically operating with the same risk level. Fulfillment has asked on YouTube, how we doing, dude? Hope you're okay. Can you please offer some insights on the monthly rotation stats? What could improve performance generally, and which values are considered good or bad? Thank you again. Now, I actually don't usually, it's a good question. I actually don't usually look at that, to be completely honest. But it basically shows how much volume you execute on month. I guess the reason that I don't look at this too much is because my volume generally is quite stable. But it's basically a measure of activity, right? Showing how much volume you put through month on month. So realistically, there's no good or bad value to that, purely based on the fact that my rotation is going to be completely different to yours. The main thing is that it's stable. It doesn't have to be. Some strategies will have busier periods. Some will have quieter periods. It's not something that is kind of good or bad, or even if it's not stable, I don't necessarily think that's a bad thing. And this is kind of why I don't get too caught up on it, is because there's a common theme across successful traders and investors, is that a small portion of their trades or investments generate a large percentage of their return. I mean, even in the case of EGXL, we have this DAX trade. Now that is 6.93%. 6.93 is a large portion of this 8.53% return. Okay, now I know it's just one trade. We're not accounting for drawdown, all that sort of stuff. But without that one trade, their return would be like 1 or 2%. Okay, so with that in mind, I don't find it a red flag if somebody has a month of higher activity or a month where they put through more size, whatever it may be, because I generally don't think that affects a trader's profitability overall. I do think, like I say, a small portion of trades often makes up a large percentage of return. And so I don't think that there's always a direct correlation between your rotation and your performance as a trader. The caveat to that is that you can find times where, like looking at this now, if there's like a random spike in the middle of nowhere, you might think, I wonder what happened there. And it might be that the trader lost their head and just peppered trades for a week. And, but, the cases of that are quite rare. And like I say, I don't get too caught up on that. I'm sorry if that doesn't answer your question in terms of giving you kind of an insight into that statistic. But, well, I guess I have given you an insight into that statistic. But I just wouldn't be too concerned about that overall, unless you feel like, what you could do is, if you feel like you're getting too active, is check your average monthly rotation and then compare your current amount of size that you're putting through compared to, well, I guess actually I've just thought about it. I've never done this, so I'm just spitballing an idea. If you're going through, or you could look for patterns through periods of good performance and periods of bad performance. So if you have, let's say, 6 months of stagnation, look at the average rotation. If you have 6 months of pure growth where you're just, can't do anything wrong, everything you touch turns to gold, have a look at the rotation there. If there's a clear discrepancy between the two, then what that might tell you is that when you're more active or when you're less active, you perform better or worse, and you might be able to find a pattern there. I don't know, because I haven't looked into that for too many for any traders. But I think you would pick up on that pretty quickly if you ran that test. But again, I don't think it's gonna come to much benefit, to be completely honest. Now, last but not least, we have the capacity tab. Now, this shows how much capital you can manage as a trader. And surprisingly, not many people know that we actually measure this. So what we do is we look at your trades. We measure the toxicity flow of the orders that come through your trades. We then measure from the toxicity flow how much divergence an investor would have based on the amount of capital that they invested into you. I apologize if this is too complex. I'm trying to make it as simple as possible. We measure the divergence that they would get based on certain amounts of slippage, dependent on the amount of capital that they provided to you, and then what their return would be based on that. And that then, therefore, gives you your alpha cap or your max investment. So if we take a look at to check all the periods, so you actually have a really high score. So you're scored 9.1 out of 10, which tells me that your max investment is going to be quite high. Now, based on what I've just said, your Darwin as of June 30th, as of this Monday, because this gets updated every Monday, your return was 8.64%. Now, if we look at the bottom figure, which is if an investor was getting slipped 2 pips on average on every single trade, they would only be up 4.16%. So it's a divergence of about 50%, right? You're up 8.5%, they're up 4.25%, pretty much. So it's a pretty big difference. And what we can't do, and the reason why we do this, is we can't advertise your strategy as doing 50% a year if 2 pip slippage for an investor is going to cause them to have a 10% year, because it's our asset management license on the line. Like, we're advertising your strategy to investors. We have to make sure that it's going to perform for an investor the way that, we advertise it on the tin. So with that in mind, your maximum investment right now is sat at 177 million US dollars. I don't know why yours is quite sporadic. Like, you have a peak there, it falls off. You have a peak here. I'm not 100% sure as to why that is, but as of right now, your alpha cap sits at $177 million. So I don't think you're ever going to have an issue of needing more space in your system. That is significantly high, and I don't think it's ever going to be a problem. The people that this is a problem for are traders who have an alpha cap of 50k, 100k, and they go, I'm going to become the richest trader in the world. I'm going to go and work at this bank and do this. I'm going to take over. And then you go, well, your alpha cap's 100k, so you're not going to be able to do anything above 100,000 AUM. And they're like, oh, what? So now they have to rethink their whole system. And usually this is derived by basic things that you think it would be. Like, do you enter trades with a wide enough stop? If you're scalping in a liquid market like the UK 100 with a 2-tick stop. Of course, it's going to be difficult because every time an investor enters, they're pretty much going to be stopped out before they enter the trade. And therefore, your max investment's got to be super low because you can't clip size on that. So I don't really have an answer on how every trader can increase their max investment. Just try and let trades breathe, have a stop size big enough to allow for size to get in the market, and trade liquid assets. That's kind of all I can give you. It's ranges by person and by strategy, like the things that you can do to increase it. But there is no one holy grail that will magically make you be able to manage, $500 million or $10 billion. There's nothing that there's no pill you can take to make that work. So anyway, that brings us to the end of the session. So we've looked at all of the metrics that we have on Darwinex Zero, or at least the majority of the metrics that we have on Darwinex Zero, and the same on Darwinex. I hope this has helped you. I see Chimmy's had to leave the session, only just. So I mean, if Chimmy's watching this on recording, I hope this was insightful for you, and for the guys watching it who aren't Chimmy, I hope it was also insightful for you. Take everything that we've spoken about and go and apply it to your own Darwin. Take a look at your own metrics and see if there's any patterns that you can kind of exploit or change there. Again, it might be something that we've discussed today. It might be completely different because your record and strategy might be completely different. But it's always important to look at variables that you don't look at on a daily basis, like what's on the chart. So before we finish, I'm just going to check the Instagram to... I didn't click go live on Instagram. What an idiot. Oh, what an idiot. Well, I guess I don't have to check the Instagram to see if there's any comments because there's not going to be anybody watching on Instagram. Fulfillment said, all good, thank you. Pleasure to answer your question, dude, and thank you for joining. I just want to say thank you to everybody for watching. If you missed some of the session, it's going to be uploaded on YouTube or Twitter, so feel free to go and watch the session, and we will be back tomorrow at 4 p.m. UK time to do a Darwin explanation session. So with that, have a fantastic rest of your evening, guys, or morning or afternoon, depending on where you are in the world, and I will catch you all tomorrow. Peace out.